So if you've been watching the bond market lately, you might be feeling, well, a little lost, right? It's been pretty chaotic. But what if all that chaos actually opened the door to a really unique opportunity for high income? That's what we're going to dig into today. We're looking at an ETF called TLTW, and the whole idea behind it is to generate a double-digit yield from, get this, one of the safest assets on the planet, U.S. Treasury bonds. Sounds interesting, right?
And this quote from our source really just nails it. Yes, we can be boring and sexy at the same time. I mean, come on, that's great. It perfectly sums up what we're about to unpack. We're taking the traditionally, let's face it, boring world of government bonds and giving it this high-income twist that's frankly pretty compelling in today's market. So let's get into how this thing actually works.
All right, first, a little bit of context is key here. It wasn't that long ago that the market was in a total panic, right? Everyone was freaking out about inflation and the Fed's whole higher for longer mantra with interest rates. And what happened? Well, it sent long-term bond prices into an absolute nosedive. I mean, one of the worst we've ever seen. So if you were an income investor, you were probably scrambling, just wondering, where on earth can I find a decent, reliable return anymore? But you know how it goes. Out of that chaos, an opportunity often pops up. And this time, it created the absolute perfect environment for a new kind of strategy to really shine. You could almost call it a contrarian darling that was just built for this exact moment. And that brings us to TLTT. Now, the full name is a bit of a mouthful, don't worry about it, because the concept itself is beautifully simple. The fund really just does two main things. First, it owns something you might already know, the popular long-term Treasury bond ETF, TLT. Then, and this is the important part, it sells what are called covered call options against those bonds every single month to generate extra cash. Okay, so I just mentioned covered calls. You might also hear it called a BuyWrite strategy. So what exactly is that? Let's break down the playbook here and see how it generates that really impressive income stream we're talking about. It's actually a classic three-step move that stock investors have been using for decades. First, you own the asset. In our case, that's long-term Treasury bonds, held through TLT. Simple enough. Second, you sell someone else the right, not the obligation, just the right, to buy those bonds from you at a slightly higher price down the road. And third, and here's the kicker, for selling that right, you get paid. You collect an immediate cash payment, and that's called a premium. And that premium, that's pure income, straight into your pocket. Now, here's the secret ingredient. The thing that makes this strategy so powerful right now is volatility. I mean, think about it. Since 2022, the bond market has been on a wild roller coaster ride. And when volatility is high like that, the premiums you get for selling those options, they get much, much bigger than normal. That chaos, that volatility is literally being turned directly into cash income. And that brings us to the main event, the reason we're all here. How does this all translate into actual, numbers? This isn't some kind of financial magic trick. It really is just simple math. And here it is, the number that's been turning a lot of heads. Recently, TLT has been paying out a distribution yield somewhere in the neighborhood of 10 to 12%. Yeah, you heard me right, a double-digit yield from U.S. Treasury bonds. So where does all that income come from? This chart breaks it down perfectly. You see, a part of it, maybe 4 to 5%, is just the normal interest you get from holding the Treasury bonds. But the lion's share, a whopping 6 to 8%, comes directly from selling those options. That's the real engine here. So, to be super clear, there are two key conditions in the market right now that are fueling this whole thing. First, like we've been saying, is the volatility premium. All that market shakiness makes the option income way higher than usual. And second is something called bond price compression. Basically, the bonds themselves are trading at a huge discount after that historic sell-off, which just gives you a much more attractive starting point for the whole strategy. Okay, let's zoom out a bit. The mechanics of this are pretty clever, for sure. But what about the big picture? What's going on in the broader market? This is where the thesis behind this really gets interesting, because it frames this moment as a classic case of, well, fear meeting opportunity. If you look at history, bond markets tend to move in pretty predictable cycles. You know the drill. Inflation spikes up, the Fed steps in and tightens policy, and then the economy starts to slow down. The argument here is that we are right there at step 3. And if history is any guide, the next logical steps are the Fed starting to cut rates, which usually triggers a big rally in long-term bonds. So, where does TLTW fit in with other choices you might have?
This table lays it out nice and clear. Look, if you're just super bullish on interest rates falling and you want pure, direct exposure to that, then the original TLT ETF might be your go-to. But if your goal is to generate high monthly income while also holding a kind of defensive position, well, TLTW was designed for exactly that scenario.
Now, of course, we all know there's no such thing as a free lunch in investing. So to make a smart decision, you have to understand the trade-offs. Let's get real for a second and talk about the risks and the reality checks. It's not all smooth sailing.
So, what could go wrong? Well, there are three big things to keep in mind. First, interest rate risk. If REITs decide to spike higher again, the price of the bonds underneath it all is going to fall. That high income definitely helps cushion the blow, but it might not erase a loss completely. Second is what we call the call cap. See, by selling those calls, you're agreeing to cap your upside. If bonds rally really, really fast, you'll miss out on some of those gains. That's the fundamental trade. You're swapping some potential big gains for steady income. And third, those juicy payouts can be volatile. If the bond market suddenly gets really calm and boring again, those option premiums will shrink, and that means your monthly distribution will shrink too.
But there's another side to this, a really underrated benefit that kind of acts as a counterweight to those risks. And it's all psychological. Think about it. Getting paid a significant check every single month, even when the market is going sideways or down, makes it so much easier to stay patient. It helps you avoid that urge to panic sell. It basically turns volatility from something you fear into a feature you're actually getting paid for. And this really brings us to the core thesis here. The source material sums it up perfectly. They describe this as a rare setup. Heads I win, tails I still get paid. It's what you'd call an asymmetric bet. If rates fall, great. You stand to win with both income and the bonds going up in price. But if rates just go sideways or even tick up a little bit, you still collect that big-time income from the option premiums. So we'll leave you with this final thought to chew on. The big idea behind a strategy like TLTW isn't really about trying to perfectly time the market. I mean, who can do that? It's more about tilting the odds in your favor. It offers a way to potentially earn a really high yield while you just wait for the next phase of the market cycle to unfold. So the question you've got to ask yourself is this: in a market like this one, are you getting paid to be patient?